In the investing game, the mantra goes, buy good companies at the right price. Sure, you can find giants generating profits for years, sturdy anchors in any portfolio. But where's the real thrill? The heart-pounding opportunity? That lies in the dip, when a sharp correction sends prices plummeting and fear hangs heavy in the air. For the savvy investor, this is prime territory, a chance to build positions in these fallen titans at a discount, ready to ride the inevitable rise back to strength. So, when the market screams and others run for cover, remember, a smart investor hears a different tune, the sweet music of opportunity beckoning from the depths of the downturn. It's time to dive in, not out. Today's market might have you running for the hills, but hold on. We're not here to join the stampede. We're here to pounce on opportunity. 2023 may have dealt some blows to two blue-chip giants, sending their stock prices into a terrifying nosedive. But amidst the panic, I see a silver lining, a chance to snag these fallen titans at a discount. The sell-off has stripped away the excess, leaving behind pure potential. Fear has driven down their price, but their fundamentals remain rock solid. So buckle up, because in this video, we're diving deep into these two bargains, dissecting the downturn, and uncovering why this might be the perfect time to build your position in these future champions. Are you ready to turn fear into fortune? Let's go! Our first stock on the list is Pfizer, ticker symbol PFE. Pfizer's story in recent years is a roller coaster ride of soaring optimism and sobering reality. Pre-pandemic, it was a steady performer, hovering around $30 a share. Then came the COVID-19 storm, and with it, the vaccine miracle. By December 2021, driven by investor frenzy, the stock price doubled to $61. But as the pandemic gradually receded, anxieties about Pfizer's future surfaced. The once sky-high stock shed half its value by the end of 2023, now languishing around $28. So, has the mighty Pfizer fallen forever, or is this a hidden gem waiting to be rediscovered? The $43 billion acquisition of Seagen wasn't just a headline grabber, it was a strategic masterstroke. Seagen's cutting-edge antibody-drug conjugate, ADC, technology is revolutionizing cancer treatment, and Pfizer holds the key. Other companies will utilize this technology, paying royalties that will fuel Pfizer's future growth. And here's the icing on the cake, Pfizer expects nearly $1 billion in cost savings from this deal within the next 3 years, directly boosting its bottom line. Pfizer currently carries a hefty $64 billion debt, and high interest rates make it expensive to maintain. But here's where things get interesting. Economists predict potential rate drops to as low as 2% within the next 2 years. This translates to millions saved annually on interest payments, directly boosting Pfizer's profitability. Forget fancy jargon, let's talk cold, hard cash. Right now, Pfizer is paying a juicy dividend of over $1.60 a share, translating to a whopping 5.8% yield. And guess what? As interest rates fall, those government bonds start looking less appealing. Investors seeking decent returns will inevitably flock to dividend-rich stocks like Pfizer, potentially pushing its price even higher. With Seagen's innovation, future cost savings, and a mouth-watering dividend, Pfizer isn't just recovering, it's strategically evolving. Sure, the pandemic windfall is gone, but the fundamentals remain strong. The current dip might look scary, but for savvy investors, it's a golden opportunity to grab a piece of this healthcare giant at a discount. So, the question isn't whether Pfizer will rise again, but how soon you'll join the ride to the top. Our second stock is Bristol-Myers Squibb, symbol BMY. While 2023 wasn't exactly kind to Bristol-Myers Squibb's share price, down 27%, don't be fooled by the frown on its face. This biotech giant is brewing a potent cocktail of strategic acquisitions and a burgeoning new product portfolio, ready to rewrite its future. The expiration of blockbusters like Revlimid and Opdivo cast a shadow over Bristol-Myers' recent performance. But instead of wallowing in nostalgia, they're shaking things up. Three savvy acquisitions, totaling over $20 billion, are the secret ingredients in their comeback recipe. Karuna's schizophrenia fix. This $14 billion deal bolsters Bristol-Myers' neuroscience pipeline with KarXT, a promising treatment for schizophrenia and Alzheimer's. Mirati's lung cancer arsenal. 10 late-stage cancer drugs from Mirati are now Bristol-Myers' weapons against the disease, strengthening their oncology arm. RayzeBio's radiopharmaceutical powerhouse. For $4.1 billion, Bristol-Myers gained access to RYZ101, a potential game-changer for treating neuroendocrine tumors and lung cancer. These acquisitions are more than just trophy purchases, they're the foundation of Bristol-Myers' ambitious new product portfolio. By 2026, they expect this portfolio to generate over $10 billion in revenue, and by 2030, a staggering $25 billion. Sounds like a pretty sweet return on investment, doesn't it? But Bristol-Myers isn't just buying its way to success. They've got 12 assets entering the final stages of testing and another 30 in early development, spread across oncology, hematology, and more. With 16 phase 3 trials and 34 in phase 1, their pipeline is a veritable laboratory of innovation. And let's not forget the cherry on top, a juicy $2.40 dividend per share. Just like Pfizer, Bristol-Myers stands to gain handsomely from potential future rate cuts. Lower interest rates mean cheaper debt, boosting their bottom line and making the dividend even sweeter. While the current dip might seem daunting, it's actually a golden opportunity to grab a piece of this pharma powerhouse at a discount. Bristol-Myers is in the midst of a strategic transformation, and with its pipeline brimming with potential and its financials bolstered by dividends and rate cuts, the future looks bright for this healthcare giant. So, buckle up and get ready to witness Bristol-Myers Squibb's metamorphosis from patent peril to pipeline paradise. The future of healthcare shines brightly for both Pfizer and Bristol-Myers. Their robust fundamentals, cutting-edge pipelines, and unwavering dedication to diverse medical needs solidify their positions for continued growth. For investors seeking to capitalize on this potential, consider strategies like selling put options with 6 months or more expiry. Generate income while remaining optimistic about the stock's long-term trajectory. Implementing a split buying strategy. Gradually build your position over time, mitigating the risk of entering at a peak price. Employing dollar cost averaging, DCA. Invest a fixed amount at regular intervals, regardless of the stock price, to average out your cost per share over time. Thanks for watching.